Good afternoon. It's Wednesday, January 21st, 2026, and the headlines today are screaming about the Arctic blast and the effect on natural gas, even making LinkedIn headlines as natural gas futures surge 50% in two trading days, the most two-day gain since 1990. So this reminds me of the Arctic blast we had back in 2014, where short-term prices surged, as well as utility pricing went up in the order of magnitude about 13% that month back in January of 2014. Fast forward to January 2026, and we are in a much worse situation as this polar vortex, as opposed to the one in 2014, is going to last much longer. So what this means is rising utility bills, not just in the short term, but in the longer term. But what I wanted to do is reflect on this, not just show you, here's the chart. Obviously, everybody can see that we've jumped 50% in 2 days. And if we zoom out on a weekly chart, this is a 5-year chart. We're way back up. A couple of weeks ago, I had put out a video that a great opportunity was right here in that $3 range, and the market expected us to continue to go down. Some analysts were calling for a $2 settle in the future, but all it takes is a headline and a weather headline to jump these markets. So that's exactly what happened. So basically, what you're seeing here is speculators moving the market, meaning they got caught off guard. So when everybody was screaming that the rates or the pricing was going to go down to $2, people, basically traders and speculators, speculated or shorted the market here at $3, expecting to go down to $2. But what happens when those short positions are called out because a weather headline hits? Everybody starts closing those positions and then have to buy the contracts that cover their short. And then the whole herd psychology happens, and everybody starts covering their shorts, and that's why you have a 2-day 50% jump in pricing. So just wanted to show you that real quick, but wanted to express or show, all right, what does 50% in 2 days translate to your actual utility bill? And what I want to show here is an example here of what this move means for your bill. So basically, at the beginning of the month, when everything was honky-dory, pricing average around 315 an MMBTU. Fast forward to the most recent jump, and I'm throwing in an estimate that the rest of the month will be elevated up in these high fours. So we'll probably average 490 for the rest of the month, and that's your 55% jump. I'm calling it from the first half of the month to the second. So combining the two, I'm estimating that the settlement is going to be probably around $4.03 for a steady use customer. Let's say a restaurant or somebody who uses cooking gas, somebody with a steady monthly load for the entire month will probably end up at that 403. But since we're in a polar vortex or an Arctic blast, we're going to have those heating accounts really increase significantly in that usage. So the settlement's going to be more heavily weighted to the back half of the month. So I call it 475. So what does that mean and this whole thing is based on a variable contract user in a deregulated gas market, let's say in Florida or in New York, New England, Midwest, wherever gas can be purchased in the secondary market. Many customers felt, just like the market analysts thought, that the market was just going to go down because of supply and demand and warmer weather outlooks a couple of weeks ago. So they just held on to their variable rate contract. And as I warned back then, it's always good to, during the good times, aka low prices, to hedge for your long-term bad times, with what we're seeing today. So if you had hedged back then for a fixed price, you probably hit a market. You caught a perfect market bottom, but today we are higher, not 50% higher. So there's still opportunity. I want to make this point. There's still opportunity in the gas market to go long fixed at a decent rate. So the future curves or the forward pricing actually show, about a 10-11% increase overall, versus these headlines of 50%. So the net effect, if you're out there trying to purchase your gas for the future, is actually a 10% rise. And that goes for electricity too, since electricity is tied to natural gas price movements, because a lot of the generation in the country is fired by natural gas power plants. So what you're going to see on the electric wholesale market, if we were doing the same analysis, is a longer term price jump of about 10% on the wholesale electric markets across the country. So getting back to this gas example, so let's assume that a variable rate contract holder has a NYMEX plus, well, that's the NYMEX plus $2, let's call it, just for example's sake. So if this steady usage customer settled at 403 and had a $2 basis, their base rate is $6.03. Now that same heating customer, or a different customer that's a heating account with a much more weighted towards the back half of the month, would have that same contract settle at 475. At the $2 basis, they're ending up at a 675 build rate at the end of the month, let's say, from their supplier. Now, if we just zoom back a couple of months, in October, the monthly settle was 284 at that same basis. That customer's bill was 484 back in October. And when everybody was saying that the market's going to go down to $2 or whatnot, they expected the settlement to probably be around that $3 mark there, and you had the two. So at the end of this month, people on a variable rate contract were expecting $5.05. But the reality of the Arctic blast is going to probably end up more like the following. So on those steady accounts, aka the restaurants, the cooking load, those kind of flat loads, that bill's probably going to be more like $6.03, which is a 19% increase. So you're going to expect to see, when you look at your bills in February, probably a 19% increase in your overall bill. Now the heating customer, let's say in New England or Midwest or New York, on a variable contract, is actually going to see a 675 build rate versus an expected 505. So they'll see a 34% increase in their bill come February, and then everybody's going to start crying and yelling about how high their utility bills. So just a warning, this is probably the net effect of what's happening there. So this is all to say that two concluding points. One, there is still opportunity in the long term, so don't be frightened by a 55% spot move, because spot is just the past 2 days. It's the prolonged, longer term hedges that still make sense. Again, those are up. Yes, they're up, but they're up 10% versus a market bottom a couple of weeks ago. So the overall picture is still very favorable, not long term. And so it does make sense to do that long term still. And the second point is, your bills are going to go up. If you're a variable rate contract, you are going to see these kind of increases, and expect this market to stay elevated, especially if this weather continues, as the true supply and demand economics will kick in next month. As if this weather continues, we're going to have much higher demand both from power plants and heating accounts, which will put the call those macroeconomic factors, keep those prices high, and that affects these longer term hedges as well. So it makes sense to take advantage of the market now, even when it's this elevated, when headlines are screaming, don't do anything, or putting fear in everybody's head, again, I look at the data, I look at that long-term data, zoom out and see what the actual effect of this is long-term, and you'll see that you still have an opportunity today. So it's very important to implement a strategy, as I've been saying, for months now, and for our platform is to, as we look at things, as we get people rebates, and then we look at rate optimization, which this is a rate optimization pillar of our platform. We are urging our customers to go long on a fixed to prevent these headlines from affecting you. So again, you can shrug these headlines off your back. If you're hedged, you are protected from all this volatility, and that's the whole reason a smart energy procurement strategy exists, is to prevent you from participating in these wild short-term moves and just have a stationary budget going forward. And that goes on the electric side too. Though it's a bit more complex, there are strategies to mitigate this volatility. And then further down our platform is, the ultimate way to reduce your utility bills is to reduce your usage, and that's why we have things like HVAC optimization, our harmonics device, and our water valve is to give you a complete picture on reduction. So if you combine these strategies, is why it's a strategy. The optimization platform is so powerful that it gives you a 1, 2, 3, 4 punch to combat this volatility and improve margins. So if you want to take a look at those bills, please reach out to us, and we gladly do a free evaluation for you and explain how you can save on ongoing costs and improve margins. Thanks.